How are you guys doing? So first, I want to thank Anthony for dressing up for us today. Very nice of you. Very nice.
It's an Iconoclast event, I thought. They said,
Yeah, you're
they said
iconic.
Iconoclast.
No
I
doubt
figured,
about
let me
that.
just throw up the Iconoclast wardrobe. Go ahead, Ron, keep it up.
Yeah. This is so great. Normally, he's busting on me about my beard, so I get to give it back to him a little bit.
I told him he was my rabbi backstage. He got very upset.
I also want to thank Forbes for inviting us, and Minit in particular for getting us all here. So we are here to talk about the future of alts, and we have a great panel that really makes up a variety of the different aspects of the alt universe. So before we get into kind of the individual areas for each of you, I'm just curious if anyone, I'll just throw it out to the group, if anyone has any thoughts on just what is the tone in the alt market in general. You know, we hear a lot about the denominator effect, and clearly, you know, tech in particular has really taken a hit in the last year. So where do you think we are in terms of the interest in alt?
Well, there's always interest in it, but the money for it has not dried up, but has slimmed down a bit. People are still investing in it, but if you look at the venture capital space in particular, which has a very long time horizon to getting your money back, and hopefully many times your money back when it works, there's no question that the denominator effect has been a significant inhibitor of growth of new funds.
Yeah, I would just add, I mean, as you said, the denominator effect is definitely real, but even when you look at year-to-date performance just on the equity markets, right, those have been up and the denominator effect is still hurting us, and I would argue that's largely a result of just, as you were saying, just the lack of return of capital across private equity, venture, and probably some other asset classes as well.
Yeah, from my point of view, so like you look at a year like 2022, especially when not only equity fixed income markets were down, but when the correlation goes up. And I think every investor kind of responds to that by saying there's probably not enough uncorrelated, unique investments in my portfolio. So I think it bodes well for all of alternatives, and specifically alternatives that are uncorrelated.
I guess what I would say is about 12 years ago, there were $2 trillion of assets in the hedge fund space. I think there's approximately 3.8 trillion today, yet the market has gone up more than that. So if you had asked me 12 years ago, I would have thought we would have had at least 6 trillion in the space by now. And I think the central reason for that is a zero interest rate policy. So we're now embarking upon a normalized interest rate market. And so while assets have been tepid, asset gathering has been tepid, you could be in a scenario over the next 12 to 18 months because of where interest rates are, Ron, where we start to see more activity and more inflows into the space.
Yeah, that makes sense. And I guess you do a lot of hedge funds at JP Morgan,
Yep.
Paul. I will tell you, at my event in Miami, we run a big capital introduction event. I mean, I sell this thing out every year, right? 700, 800 funds are there. Mm-hmm. But I feel like there have been, where the flows seem to always go are to these huge complexes now.
Sure.
Citadel, Millennium.
Sure.
Do you expect that trend to continue?
Yeah, I guess I'll take the other side of it. I mean, you know, on one hand, it's you know, if you extrapolate the past, you'd say, you know, 5 years out, there's going to be 6 funds that kind of matter in the whole hedge fund world. I think the problem with that is a couple things. I mean, first, I'd make the observation, I've been doing this nearly 30 years, and anytime anyone kind of comes to the same conclusion, it's usually wrong, whether it's Russia in '98 or SPACs more recently, you know, even multi-strats in 2006. So that's first. But, you know, I guess more tangibly, fee structures are obviously really high. You know, you have kind of pass-through fees of 5 to 10% in many cases, plus incentive fees. So it's a really heavy fee load. You've just gone through really what was probably one of the best times for kind of multi-strats in the last, you know, 3+ years. If that doesn't continue, I think that fee structure is going to be all the more weightier on, you know, on overall fund returns. And then similarly, like, competition for talent is just crazy, right? So it was always really severe. It was always a fight. X's point really turned it into a war. And it's been that way for a number of years now, right? So again, not only the load, but the type of structure, much more front-end loaded. It's you know, weighs a lot on things. And then lastly, I'd say, as more and more investors kind of rush to get into these, especially more like the second tier ones, I question whether they really are going to have the longevity of capital to kind of look past a couple of weaker years. So I don't think it's dire. I think they'll continue to grow. I think the rate of growth is probably a much different one than you've seen in the recent past.
Yeah. Now, you and Anthony are both in the fund-of-funds business, and I feel like I hear frequently about providing access points to retail in particular. Are you seeing different structures and different approaches to make the asset class more accessible? I guess that's really both.
You want to first?
Well,
Anthony?
I mean, so we have a 40 Act product, and so we have $25,000 and $50,000 minimums, and so that's worked. We have over 6,000 clients in the fund, and our performance is getting better again. So hopefully that'll lead to more assets. But yeah, I think if you set it up in a 40 Act fund, Ron, you can give a client a 1099. Retail investors like that.
Yeah, and we have a useless fund as well, but I'd probably broaden it to say, like, one of the biggest evolution points, I think, for hedge fund solutions or fund of funds is the increased use of managed accounts. And maybe it's not known as visibly, but it's definitely really, really important. It kind of blurs the line between hedge funds and fund of funds, and it creates a kind of a moat around what you do and what you deliver to clients. So as more and more people kind of doing it themselves, to create a series of managed accounts provides you with a number of things. You could be more nimble, you could do much better on fees, you could be much more capital efficient, and you could structure it in a way that hopefully delivers more alpha as well. So I think that's really important, and not everyone can kind of replicate that. And it definitely is, I'd say, an increased importance of what we would deliver to clients on a go-forward basis.
So, Howard, Anthony and Paul are in the more liquid end of the market. You are, actually, you've had a background in really all of it. A co-founder of Idea Lab, Renaissance, one of the most successful hedge funds in history, and First Round Capital with Josh Koppelman, one of the most successful venture funds in history. I'd love your take on how what does venture look like moving forward, not just here in the US. I think clearly it's a very well-established industry in the US, but I feel like I'm hearing more about venture globally. Do you have a perspective on what's really happening outside of the US? Sure.
If you go back to 2012, sort of 85% of the unicorns were Silicon Valley. You look at 2021, 2022, 20% are Silicon Valley, and 40% are China, and 40% are rest of world, rest of US, rest of world. There's been a huge growth outside of Silicon Valley in the last decade. And at B Capital, we started out as a global fund based in Singapore and as well as the US, with a lot of investment in India. India is growing at 6% a year. It's kind of like China was 10 or 15 years ago. So we see a huge opportunity. India, Indonesia, Southeast Asia in general, Israel always, with what they're doing there, a little bit of Latin America. So we put about a third of our funds outside the US, US and Canada. And we think that's where the growth is coming. And that's the democratization of information because of the internet and now the Gen AI world means that you can create great companies anywhere. And those great companies can hire people anywhere. So you have US companies hiring people in India. You also have companies in India hiring people in Romania and in Buenos Aires, Argentina, and in the US. It's created a global economy, and we're investing heavily in that.
Yeah. So, Laura, you're in the sort of larger scale, but private structured products, primarily in the credit area. Tell us a little bit about what's going on in private credit. I feel like I hear that a lot. Certainly at our events, we have tons of private credit funds attending. What's the future there?
Yeah, no, I mean, private credit clearly has been a rapidly growing asset class, both for institutional investors as well as for retail investors. And even the term private credit, right, is so broad. It encompasses a lot of different strategies, everything from direct lending to opportunistic, distressed, mezz. There's lots of things, I think, that roll up into private credit. I focus most of my time on direct lending. So I do think direct lending is a particularly attractive asset class right now for a couple reasons. One, just being the enhanced yield. These are floating rate loans, typically generating 600 to 700 basis point spread. So that's north of 12% return for first lien risk. So that feels pretty good to us. In addition to that, the capital structure evolution, if you just compare a leveraged buyout from 2007 to today, they look totally different. In 2007, I think the average LBO was about 10 times enterprise value and financed vast majority with debt, like 65% debt and 35% equity. So it was really an equity option for the private equity firms on the backs of the lenders. Whereas today you have about 65% of the capital structure being equity and only 35% of the capital structure being debt. So you feel a lot safer in the capital structure with all that junior capital below you. So when we think about lending to high quality businesses at $1 risk, backed by strong private equity firms that have a lot of junior capital below us, and achieving a double-digit return to do so. That feels pretty good overall. And the last thing I would just say is it is a growing market opportunity because we've seen this secular shift from the syndicated market to private credit. For a variety of reasons, but I think most importantly, it's because it's a really attractive solution to the borrowers and the private equity firms because it's faster, easier, more certain execution in a lot of ways. And it's also just big enough now such that larger firms can go to the private credit market as a solution. You're no longer just relying on a syndicated market for $1 billion financing. You can easily do that now in the span of a private credit option.
And where are rates now in a private credit deal?
Yeah, so typical unitranche loan would be SOFR plus 600, SOFR plus 700. So that's that north of 12% when you incorporate the base rates because they're all floating rates. So it's pretty attractive.
Yeah, that's great. And Howard, just thinking about credit in the venture world, obviously with Silicon Valley Bank falling out of the market. Well, I guess not exactly falling out of the market. Maybe the name's changing, maybe it's not, but technically it's still there. Obviously the brand's been dinged. But do you expect to see venture debt continue to play a role in the venture space to the same degree?
Well, Silicon Valley Bank created a category that was really paid for by the warrants. So if you look back in 2020, they made over $500 million on exercising warrants as companies went public. In 21, they made about $150 million. I think that First Citizens is not nearly going to be as loose with credit as Silicon Valley Bank was, but I don't think they're going to give up that business. And you saw them go to the lawsuit in England over Hong Kong, Shanghai, hiring too many people from them. I think they want to keep that business growing, but obviously with tighter credit limits. So maybe they don't lend to the seed stage companies, but they wait until the companies have some revenue before they start lending. But it won't go away, and it is an important part of the venture space. Yeah. Now, I think we're also going to start to see more credit funds that lend into the venture space. You have companies like WTI and Hercules and others that do lend to ventures and have done very well. And again, that warrant kicker is what really gives those guys the real enhanced return, and it's paid off.
So I feel like we can't wrap an alts panel without at least talking for a second about AI. Everywhere I go, I was at the Launch Angel Summit last week. Everyone's talking about AI. Everyone's adding AI to what their business plan.
We don't have a company that we've invested in the last 5 years that doesn't have AI somewhere in their operations. Now the generative AI has exploded. They're all trying it. You heard earlier today about the hallucination effect, so you have to be very careful. But it is world-changing. There's no question about it. And we're investing in companies that have a proprietary data to train on and a proprietary edge. We're not investing in OpenAI or Google's piece, but there are lots of places that can use that to have a real advantage.
Yeah. So when you think about a venture fund, obviously they're there to provide that early capital. But if companies become so much more efficient because AI allows them to do so much more with so much less capital, do you think it changes the dynamic of early stage investing for funds?
At the early stage, it's so much about people and the right people with ideas that I don't think it changes it at the seed stage. I think it does change it at the B and C stage, where companies will need less capital. or will grow faster because of using AI to do things. If you needed 50 customer service people, you'll now need 10 with the AI agents doing the work of the other 40.
Yeah.
And that's less capital need.
That makes sense. Paul, any thoughts on AI and how it impacts your part of the
Yeah,
alt
I mean, I think I would certainly reiterate it's real, it's important, it's going to be more and more of a force over time. So like we've been investing in machine learning quant funds for a long period of time, and I guess one of the reasons I grew kind of increasingly concerned with kind of like fundamental investing, not that it can't still work, but certainly people that are operating in a similar time horizon. It's just you look at the sophistication that people are bringing and how they're using, alt data, natural language processing, machine learning in general, and applying that to different aspects of their process. And it is just so enormously powerful and pressures, I'd say, more traditional approaches. So I think, broadly, it's going to continue to increase in importance across the investment world for sure, and impact the hedge fund landscape as we go forward.
So, Anthony, when you think about what Paul just said, if you don't have AI and you're in the alternative asset industry, can you survive as a hedge fund in particular?
I mean, our industry is sort of like a match sailing race. So we're in the water looking at each other's sails, and we're trying to match up to each other. So I think we'll all end up with some elements of AI in our long-term strategy. I guess the thing that I think about openly is the regulation associated with AI, because the more you learn about it, it is a little scary. I mean, you have to take Elon Musk at his word and some other people, and then one has to wonder what types of checks and balances are going to be put in place related to AI. But yes, we're all going to have it, whether we like it or not.
Laura, any thoughts? Will it impact private credit?
Yeah, no, definitely. I mean, it seems like every investment committee discussion, we're always asking ourselves now, okay, what is the impact, both the risks, but also the opportunities? I mean, as these guys were saying, I mean, some of it could just be a massive opportunity to take costs out and improve margin profiles. But I think we also, as credit investors, we're very downside focused. So I want to make sure we understand the risks also.
Yeah. One thing on the credit side, we've looked at companies that said that when they're doing credit analysis, they'll often have 4 analysts going through 50 documents, the detailed lending documents. They now do that with generative AI, summarizing that in 10 minutes. They get 20 man days or people days of work, and it is changing the way things are done.
Yeah, everything's more efficient.
I just feel like you and I would have done way better in school at this.
If we had ChatGPT, top of the class, for sure. All right, great. Well, thank you all for your thoughts. Let's hear it for our esteemed panel.